You know, it just brings me back to the fact that we're so far away from 3% growth, and perhaps the market, the global market, is stuck in the mud and happy to be so between 2 and 2.5%. I mean, I do think the odds of a worldwide rout are rising. I don't think it's anytime soon, but I'm just not sure how much longer we can persist with this kind of low GDP numbers.
So do you think it provides further support to the view that the Fed will be lifting off in September? I mean, you're of the view that a September hike would be positive for the market, right?
Yeah. Yeah, I do. And I do think it's going to be both positive, it's going to be symbolic, and I think the stock market is ready for it. The important thing to realize is that the Fed will continue to be vigilant with, being data dependent. I mean, it seems like a lot of people feel that the Fed's going to raise Fed futures, Fed funds rate 1% no matter what, each year, and that's just not the case. I think it's going to be slow and measured, and actually, if they don't raise rates again in January, that could be deemed as hawkish and really bad for the market.
So what's your next focal point then? We've been focusing on the sum word and expectations for the next NFP report. The Fed really need to see some further improvement in the labour market, they say, before raising rates. Do you think that the NFP will be the crucial decider? And if not, what is, in your view?
You know, I think it will be, and I think we're going to see that a week from Friday, and again 4 weeks after that. So that gives the Fed 2 chances, if not 3, before they have to make that decision. I do believe if it's status quo within consensus estimates, then fine. We're going to see that rate hike that I've been talking about for a while in September, because we have to keep in mind this is just a symbolic rate hike. It's not going to impact the financial system like a lot of people think it will.
And Paul, Steve Johnson here. What about the actual impact on the wider business environment? I've been talking a lot over the past year about the impact of an emergency monetary policy just on people's psychologies and on their investment decisions. How do you think that will play out, putting financial markets to one side, just in terms of the average person running their business? What is the impact of rising rates on them?
You know, I think it's a good thing because, whether we understand what's going on behind the curtain, I mean, I think it just signals to everybody that the Fed can and will raise rates. I mean, it's been all one way for a very, very long time. We haven't heard that phrase since 2006 about raising rates. So I think overall, it's going to provide comfort to the investors saying, hey, perhaps the financial crisis, or at least the one in 2008, is behind us.
Interesting commentary around a more gradual lift-off as well. Lloyd Blankfein said this week that the first hike will be, quote, jarring. So if we see a September lift-off, do you think the Fed will be reiterating their gradual approach to further hikes, and will it be jarring? No, I don't think it'll be jarring whatsoever. I mean, right now, what we're seeing in the yield curve doesn't suggest that. We're seeing the 2- and 5-year yields actually go up a little bit and 10 years off. I don't think it'll be jarring because it's been so well telegraphed and it's so well spoken almost every day. It's getting tiring to the point where I think the opposite is true, that if we don't have a rate hike, that would be jarring because that would be considered a negative for our economy. Is the macro landscape influencing the Fed more or less now? Obviously, we've had China in focus for some time, volatility on Chinese markets influencing confidence and what's not. But the news flow around Greece seems to be slowing. What does the macro landscape look like now, the global picture? Is the Fed still focusing on that? I think they are, but, a lot what we're talking about, it's very tiresome. I mean, we talk about Greece, that's on the back burner. U.S. earnings, they talk about that. That's come in line. China definitely is complicated. I think what a lot of people don't get is that China, I mean, as complicated and complex as the economy is, I mean, they're slowly evolving from an industrial production society to a consumer-oriented one, and that one's not going to go by easy. Also, we saw with the stock market rout that we had in June and July, I mean, it did create a lot of margin calls, but it did not affect a lot of wealth. We saw a lot of selling of treasuries and selling of bonds, et cetera. So to answer your question, yeah, the Fed's definitely looking at it. I just don't think they're looking at it with the same lens that maybe you and I would.
And what do you need to see for that US economy to start growing at a really healthy rate? I mean, we've seen unemployment come down so much. We've got extremely low interest rates. What is it that's holding back the economy and growth at the moment?
Boy, that's $1 billion question. And you know, one is like the productivity of the economy, like the overcapacity of manufacturing. I mean, it really, really troubles me. And that's really on a global scale. And the fact that the world and the United States have these fiscal measures of stability that really just smoke and mirrors. We know it is. And lastly, there's still large pockets of leverage out there, and some nations and companies with like debt, you know, that's not sustainable, especially we're seeing, you know, the U.S. dollar up 19% and seeing countries like Russia and Brazil, their currencies getting slammed a lot more than the commodities are. So I think that's something that I am very worried about. It doesn't seem like the headlines are, but that's something I'm watching.